Picture this. Your commercial loan comes due this fall. You walk into the bank expecting the rate cut everyone promised, and instead they hand you a higher payment. This year, $875 billion in commercial real estate debt hits maturity, and the rescue everybody was waiting for, it's not coming. What's going on? Raul here with UBI Group. If you own commercial property or you're carrying an SBA loan on your building, this is the one forecast you need before the second half of 2026. Because what's happening with rates right now just quietly changed the game for everyone with a loan coming due. In the next few minutes, I'll show you three things: why the rate relief everyone bet on isn't coming, what the maturity wall actually does to your payment, and where the smart money is quietly moving. And stick around. At the end, I'll tell you the one number that decides whether you're safe or trapped when your loan matures, but I won't put that number in the video, and I'll explain exactly why. Here's what changed. For 2 years, everybody with a loan coming due told themselves the same story. Just hang on, the Fed will cut, and I'll refinance cheap. That story is now dead. The Fed has held rates 4 meetings in a row. There's a new chair, Kevin Warsh, and after an energy shock pushed inflation back up, the Fed's own forecast now points to a rate hike this year, possibly as soon as October. In plain English, the cavalry everyone was waiting for just turned around and went home. Now, here's the mechanism most owners miss. This year alone, $875 billion in commercial mortgages come due, about one in every $6 of commercial debt in the country. And if you're carrying an SBA 7 loan, listen closely. That loan is variable. It's tied to the prime rate and it reprices every quarter. So if the Fed hikes, you don't get to wait for your maturity date. Your payment climbs automatically on the loan you already have. And this is where it gets real. Say you bought at 75% loan to value a few years back. Values have softened, underwriting got tighter. So today, that same building might only refinance at 55 to 60%. That gap, that's cash. Real money you have to bring to the table just to keep the building you already own. It's why more than half of the commercial mortgage backed office loans maturing this year aren't expected to pay off at all. The extend and pretend era bought people time, but time ran out and the bill came due in 2026. But here's the flip side, because this is where the smart money leans in. When owners can't refinance, buildings come to market, motivated sellers, higher cap rates, prices that were unthinkable during the boom. If you've got capital ready and you move with discipline, the next 12 to 18 months could be the best buying window commercial real estate has seen in a decade, whether you're the owner trying to survive your maturity or the buyer trying to pounce on someone else's. It all comes down to a few numbers most people never think to check. So here's what I promised you. There's one number that tells you, in about 90 seconds, whether you're safe or trapped when your loan matures. It's your real refinance gap, your current value, your actual debt service, and whether your SBA loan is fixed or floating, run together. But I'm not putting that number in a YouTube video, and not because I'm holding out on you. It's because that answer depends completely on your building, your loan, and your numbers. Get it wrong off a generic checklist online, and it could cost you the whole property. So do it right. Contact UBI Group, bring your loan, sit with our team, and we'll run your real refinance gap with you before your maturity date, not after. That one call could be the best decision you make this year. The number's on your screen and in the description. I'm Raul with UBI Group, and see you on the next one.